Hi, my name is Dinah Clark, and thank you for joining us today at the webinar with concern with investments. I currently sit as an OMERS trustee, and I work for OPSU, and I do pensions and benefits as my background. So I'll be moderating today's session, and before I introduce the session, we just have a few housekeeping items. You should be able to hear me and to see the PowerPoint presentation during the webinar. If you need assistance with your connection, please dial 1-855-352-9002 and press #1. Then press #1 again, and then once again. This will bring you to a customer service agent who can help you connect. After the presentation, we're going to open up to questions from the presenters, and that you can ask any question you like, and you can submit it by typing your question in the question area of the control panel in front of you. At the end of the session, I'll read any questions that have been submitted to our presenters for them to try to answer. If for any reason we can't answer your questions during the session or we run out of time, you can contact us at info@share.ca, that's info@share.ca, and we'll make sure your question does get answered. Now, we've scheduled 1 hour for the webinar, so I'm going to start with Jordan Berger, who will take over. I'm just going to give you a little background on Jordan. Jordan is currently the Managing Director of the Investment Division at the OPT, and they have a newly formed group called the Strategic Relations and Portfolio Intelligence Group that started in March 2016. He has, prior to that, when he was working at the OPT, he's been the executive team. He's been on the executive team as the corporate secretary, and prior to that, for 5 years, he was the director of compliance with the private markets group for OPIE Trust. He also has worked for Mercer as a principal and the head of responsible investment for the Canadian accounts, along with, and prior to that, he worked with me at OPSU, and he was a supervisor of research from 1998 onward. And so we're going to leave it to Jordan, and he's going to do an overview of looking at investing to meet the pension promise. And then Liz is going to join us afterwards, and she's going to talk from Liz Thompson from the perspective of a trustee and things you should consider when you're looking at investment. So Jordan, I leave it to you.
Thank you, Diana. And thank you to NUPGE for inviting me to participate in this webinar. So my topic is generally investing to meet the promise. That's investing to meet the pension promise. And here's our agenda. We wanted to do a bit of an overview on pension plan investing, talk about some of the concepts that are involved in developing a portfolio to meet a pension promise, talk about our approach. And here we're not really focusing on OPIE Trust per se, but really it's on OPIE Trust as an example of a mature defined benefit plan dealing with a difficult investing environment. How are they changing their investment strategy? So a lot of it should be applicable to DB plans that many of you will be members of. And then I wanted to finish on board oversight, how the board essentially looks at some of the policies that oversee investment strategy before passing it on to Liz. I should say, if you have any questions, please feel free to interrupt at any moment, but I'll just continue to power through until I get questions. We'll do questions at the end.
Yeah.
So as an overview, a traditional portfolio, they might call it a plain vanilla portfolio for pension plan, typically be more stocks and bonds. Those would be the only asset classes, usually 60% stocks, 40% bonds. And it's designed based on best estimates about returns from these asset classes. It's designed to deliver a targeted return. That could be 6% is often a typical target return. And that's over time. So there'll be a lot of ups and downs because the stock market can be fickle. And that brings me to the second point, that portfolio design and the mix of stocks and bonds or other asset classes you have is really sensitive to member demographics. Most of the DB plans are aging, they're more maturing, i.e. there are fewer active members paying into the plan for retirees getting paid by the plan, and that reduces some of your flexibility to absorb bad investment returns. So it has an impact on how you adjust your portfolio.
I think the other issue around member demographics is that people are living longer, so we have to pay pensions for a much longer period for the member and their spouse as beneficiaries, and that can That's testing plans today.
Yes, that's a very good point. Demographics change because of workplaces, but also just general social demographic trends. Smaller plans, as I say here, you probably know, will rely exclusively on external money managers to manage their allocations, which adds costs in the way of fees and alignment issues between the pension plan, its promise, and the business interest of a particular external partner. Larger plans, like ours, can invest in different kinds of asset classes, like real assets, for example, real estate and infrastructure, private assets, private equity and debt. These are assets that are not traded on stock markets, where you can make a longer-term investment and you are less vulnerable to changes in the stock market, essentially. You can de-risk things, though they come with their own set of risks. Anyway, and also sophisticated public market strategies like hedge funds, large plans like OPIE Trust and many of the much larger plans in Canada manage a lot of their investments internally, and that is done to lower fees and improve alignment between the portfolio's plan and the execution of it. And now we're going to look at some of the principles that drive investment strategy. When you make an investment, you usually have in mind what kind of return you hope to make on that investment. You got a sense of how risky it is. So a Government of Canada bond might return a 2% return if you're lucky, and it's pretty much risk-free, or you might make that assessment. It's generally seen as a risk-free investment. Investing in a new idea or a venture capital opportunity might give you a return of 30, 40, 50% or more, but it's significantly more risky. The point being that every investment has an element of expected return and expected risk, and after it's made, and you can look back at history, you can say this is the actual return and this is the actual risk. We recognize that we have to take risks to generate returns, but we're not complacent about it because it has big implications on our ability to run our pension plan. If you think about risk, let's say you have two investments that on average, are expected to return 5%. The one on the left is likely to return between, let's say, 4 and 6%. On average, that's a 5% return. The one on the right might be expected to return a 0 to 10% return. It's also a 5% return on average, but you can see that the investment on the right is much higher risk. There's a much higher chance of outperformance and a much higher chance of lower performance. Another way to think about this is with a basketball analogy. You've got two players, Bird on the above and Magic below. In a given game, let's say, they're equally as good because they both score 20 points. And you can think of that as investment returns. However, Bird takes 20 shots to get those 20 points, and Magic takes 30 shots to get those 20 points. So from a risk-adjusted perspective, Bird is a more effective, efficient player than Magic because he gets 1 point for every shot he takes on the hoop, and Magic gets 0.66 shots for every points for every shot he takes on the hoop. This is an example of adjusting two similar outcomes to reflect the underlying risk or volatility behind them. When you map all of the asset classes on a matrix that shows return on the left and risk on the bottom, this is for illustrative purposes only, you get a sense of the relationship between risk and return. So in the upper right-hand corner, you've got private equity, private equity investments. That tends to be quite risky, but the return is expected to be quite high. On the lower left, you've got cash, where there's a return of, say, 2%, so it's probably lower than that, and it's pretty much risk-free. And in between, you've got all the other traditional asset classes. So pension plans would typically combine Canadian equity, which is in the middle, with a bit of global equity, and then they combine that with bonds to have a standard portfolio.
But your goal is always to try to get to at least 6%.
Absolutely.
Anything else is just gravy.
Yeah.
Pretty much. Yeah.
But a younger plan can take a bit of a risk. They could get a 4%, and that won't hurt them so much. The point of investing in a number of different asset classes is don't put all your eggs in one basket. Where you take losses in one area, you want to make it back in others. The United States has a terrible year. You're hoping Europe's doing better and it balances out. If you think about it, an investment return has two components. One is the price you pay and the price you sell it at. So you buy it at, let's say, $100. You buy a stock and you sell it for $108. You got an 8% return on that investment over whatever period you held it. There's also an income aspect because that stock, while you hold it, that company may or may not pay some of their profits or after-tax profits back to their shareholders. And that's your return, your dividends, basically, from that stock. So the investment return in that case would have two components. 2% of the original investment is paid back in a dividend and 8% in the price that you sell it for. In total, you've got a 10% return. So one thing that we try and do in investments is basically get rid of risk by combining investments. So you're basically diversifying across a bunch of investments, a bunch of asset classes in the hopes of reducing risk while maintaining your return. So in this case, let's say investment one, given the same event happening on the left of those charts, whatever it is, Greece defaults, let's say. Investment one increases dramatically in price. Investment two decreases dramatically in price. They both have an income of 2%. If you could put those two together, you'd have the investment unicorn. Basically, no matter what the event that happens, no matter what happens to the changes in price of one of those or versus the other, you're still going to get your 2% return. You've got a guaranteed 2% return with absolutely no risk. Sounds great, but unicorns do not exist. So we have to have a process called portfolio construction, which is our attempt to take all of those asset classes, all of those investments, and balance them. And another way to think about it is as a house, like building a house that can withstand all environments. In Canada, you need a house that can handle snow, for sure, winter generally, and warm summers in much of the country. So the same house has to be sturdy enough to maintain those two, deal with those two environments. It has to have a great roof because of rain, and it has to have a strong foundation because of earthquakes or other problems. So basically, the house has to sustain all of those elements. And what we do in portfolio construction, that's not my group, but what our portfolio construction group does, is it combines all of the elements in our portfolio to try and make sure that we can withstand all environments. And the reason that we do it, and there's so much emphasis on balancing risk, is we are at a crossroads. On the left is how we used to think of pension funds, or how we used to think of, basically on the investment division side of this organization, tended to think of themselves as an asset management organization. They're dealing with asset managers all the time. They're just thinking about things from an investment perspective. They're definitely thinking about risk, but only in an investment context. To the right, we have a pension management organization where you basically add in the focus, rather than being on relative returns, beating your competition, getting higher than the market did, the focus is on being sure that you can actually deliver the pension promise. Relative returns are irrelevant if you can't actually meet the commitment you made to the members. So what we face with demographic change, and what a lot of funds are facing, is a decision. How do we move off of this asset management mentality towards more of a pension management mentality? And we took a little bit of inspiration from Robert Frost in his poem about two roads diverging in the night. And I took the one less traveled by, and that has made all the difference. We hope that is true. We shall see. Our approach is to focus primarily, as I said, on preserving plan sustainability. We've already, our contribution rates are not amongst the highest in DB world, but they have increased, and in the context of, pressures on government spending, pressures on our members' effective cost of living because of wage increases, inflation, we're under considerable and understandable pressure to maintain both benefits that are being promised to people and the contribution rate, which is the price that we basically pledged that we would provide the benefits for. We feel a great deal of responsibility for dealing with those. Luckily, our sponsors get to set those two elements anyway, so we don't have much of a choice. We have to manage to contribution and benefit levels while preserving plan sustainability. To do that, we have to take appropriate risks, and that means taking only the risks that we need to achieve our objectives. And if we do this correctly, we will evolve from an asset management to a pension management organization. This is something we use a lot internally. This is just obviously a representation of a balance. On one side, you have the assets of the plan, which are the contributions and the investment returns that are earned on those contributions. And on the right, the liabilities, and that is basically the members. We don't talk about it as them as liabilities or the promises we've made to them. We talk about this as member-driven investment, but in the lingo of actuaries and investors, this is asset liabilities. You can think about it that way. So on the left of that column, if we do not keep this thing in balance, if our contributions and investment returns together start to get lighter than our benefits, the benefits that we have promised to pay, then that balance will fall out of balance. And in an older plan, as I'm going to get to, it's really hard to get it back on track. One other point I'll make here is on the left, you'll notice investment returns is a much bigger box than contributions. That is because in a typical pension that we would pay out, perhaps 75 to 80% of the pension that you get when you retire from OPIE Trust is money that was made by investing your deferred wages many, many years ago. So the whole point of having a pension plan with their own investment staff and doing things internally is to make sure that you continue to produce significant returns based on those contributions in order to pay expensive benefits over the lifetime of the plan. And here's the reality of OPIE Trust, and this is very similar to a lot of other plans. When we started in 1995, we effectively had no retirees. At the end of the year, we had 5,000 retirees only, 64,000 active. For a whole bunch of reasons, including just demographic change, government HR decisions. Over time, over the last 20 years, our membership has declined significantly. Our active members are now about 43,000. We have 33,000 retirees, up from 5,000. And we've got 8,000 deferred members of our plan, up from essentially 0 in 1995. So this means that our active member to retiree ratio, the number of active members we have to support each retiree, has fallen from 12.8 active members to each retiree in 1995 to 2.1 10 years later to 1.3 20 years later in 2015. This has a big impact on intergenerational fairness because it means that if we were to have another 2001, a really bad investment year, all of that, the benefits that are being promised to our retirees must, by law, be, and by makes it a moral issue as well as being a legal requirement, have to be paid. So any shortfall in the plan going forward has to be made up by active members. That was fine when you had 12 or 13 active members for every retiree. It's a lot more difficult when you only have 1.3 active members to each retiree. Another complication is low interest rates. You look here on the left, over the last, basically from the beginning of recorded statistics on Western or U.S. Treasury yields, the average over the last 200 plus years has been about 4.75, 5% of 5% over those years. You'll see, not since 1934 to 56, the post-recession, the post-Great Depression, have we seen such a prolonged period of very low interest rates. We are now having rates that in many parts of Europe are below zero. So you're basically, if you put money in a savings account, they are charging you money because you're not spending it. Actually, you're not gaining anything on that. You're actually losing money over time, and people are willing to do that because they want low-risk investments, even if they don't return anything effectively. They need to diversify their portfolio. The key point here is, in a low-interest rate environment, as central bankers are essentially using low interest rates to try and revive economic growth. This means difficulties, at least in the short to medium term, for pension plans that are defined benefit. So when the interest rates drop, it means that the amount of money you can expect to get for taking risk drops. So even if you're in an investment that's just as risky as it was 3 years ago, you're going to get less return because all returns are adjusted down. So when Treasury bills, which are the safest investment you can make in the United States, are returning essentially zero, you're going to get lower returns on all investments that are based essentially on those risk-free rates. So that means lower investment returns, and expected lower investment returns means that actuaries, understandably have to set low discount rates, and when you set low discount rates, it increases your liabilities. So essentially what a low return environment means is that liabilities go up and expected returns from investments go down, so you're in a situation where that fine balance between assets and liabilities may fall out of kilter. Here's another way to look at it. The blue bars show the 30-year historical return from investing in global equity. So global stock markets, in the middle, Canadian, long-term, very safe government bonds. Over the last 30 years, those stocks have returned 8.7% on average, and those long government bonds have returned almost 10% on average. You put that together, and in a standard, typical, plain vanilla pension plan that's 60% equity and 40% bond, you have the expectation of making, based on historical data, over 9%, which is probably enough. It's a very good return and may very well be enough to meet the pension promise. Unfortunately, the 10-year forecast is considerably lower than the 30-year historical trend. So the 10-year forecast for return on global equity is 7%, and on bonds, it's under 2%. So when you put those together in a 60-40 spread, you'll see now your expected return is less than half of what it was before. And if that's below what you need to make to meet the pension promise, you need to figure out something else to do. And one thing you can do is change the balance of equities and bonds. This is just in a very simple way talking about adding different forms of risk and different basically combinations of risky and less risky assets to get to an expected return. So on the left, like a low-risk strategy that would probably make a lot of sense for a more mature pension fund, you'd have much more of your investments in bonds than you would in equities because there's much lower risk with bonds. But your expected return would only be 3%. So if your target was 5.75, for example, you'd have a huge amount of money that you'd have to make up. You'd have to find some other way to generate that, basically another 40% of the return. You'd need to find other ways to do it. If you took a typical plan, maybe you're lucky, maybe 60-40 meets your target return. In this case, it doesn't, and you've still got a gap to make up, and less than 1% return may look like an easy target, but over time it's very difficult to actually outperform market expectations. And then on the right, you could say, okay, well, obviously we need a higher risk. So, and this is often used as a reference portfolio for people who are developing more complex portfolios. We'll get to that in a minute because it's an important part of board control. But the higher risk option would be much more equities than bonds. Over a very long period, you are likely to get a much higher return than you are in the other two scenarios. But if you don't have a lot of time to get those returns because you're a mature pension fund, it becomes pretty risky to take that approach. And if you make the wrong decision and you don't have the investment returns that you need to meet your obligations, the balance falls out of whack. So essentially benefits start to grow because the discount rate is increasing the cost of those benefits. So the actuary is saying, hey, you've got to put even more money aside because the investment returns just aren't there. That grows, the balance drops, and on the left, your investment returns are shrinking. So even if contributions are stable or you're increasing them, you're making less and less money on those investment return on those contributions, and your plan is getting more and more underfunded. So what we try and do is find a combination of stocks and bonds and all the other potential asset classes. You put them together, and it creates a frontier of potential investment returns. At the bottom, you've got funding risk, or risk in general, and on the left, you've got return. Essentially, the higher the return, generally, the more risk you take on. You need to find somewhere on that frontier that makes sense for your organization. And let's say we're here. Our reference portfolio is our reference portfolio. It's 75% equities, it's 25% bonds. You've got a high expected return. You've got very high expected risk. The trick, or not the trick, the science, or well, actually not the science.
Or the trick.
Yeah, the mix of art and science that is investments is trying to find a way to shift that frontier to the left, to reduce the amount of risk while maintaining the same amount of return. So we want to be there and even further to the left. We want the same level of return with lower risk. And it's not quite asking for something for nothing, but it is, it's not an easy thing. And that's why we combine a whole bunch of asset classes. That's why we use some sophisticated investment strategies, like, very limited use of hedge funds, but some use of hedge funds, mainly to reduce volatility. That's why we use that combination of investments. While we have direct investments, it's the lower cost. Find a diversified portfolio that is developed and maintained with a very close eye on the liabilities of our plan, so that we never, ever run out of money to pay our pensions in a given year and have to sell assets, at fire sale prices. That essentially is the strategy, is to use our risk, be conscious of risk, link it to liabilities, and use it more efficiently. And this brings me to my last section, which is really on board oversight. To talk about some of the issues that are important to our board when they look at our investment strategy. First of all, they want to know that we are respecting our responsible investment strategy. We have a strategy that is based on a set of policies and principles and accountability to the board, but also below the board level. We integrate ESG in everything we do. Every time we are very conscious of the fact that it's part of our fiduciary duty to use the shares that we have in public companies or the percentage that we own in a private company to take some responsibility for what's being done at that company from a responsible investment perspective. So we are very active owners. And we also engage in stakeholders, because one of the most important things about responsible investment is it is not a solution to the world's ills. It is hopefully a better and more progressive way of investing money, but governments and strong social activists and NGOs really have to, if they drive progress more than investment planning, in my opinion. I mean, investment organizations like pension funds can always do a better job, but it's important to engage with regulators to talk about systemic things that can be done to address RI-related concerns. So in our plan, like many plans, we recognize that ESG factors can affect investment risks and returns, as well as our reputation. We are a member of the UNPRI. This is probably the world's leading forum for pension funds and others who are interested in responsible investment. There are more than 1,200 signatories now globally, and trillions of dollars under management by organizations that have signed the UNPRI pledge. Our commitment to responsible investment is enshrined not only in signing that, but in separate policies. It's discussed in our statement of investment policies and priorities, and we have a separate public responsible investment policy. And in our supporting investment policies that are internal management policies, we cascade a lot of the same principles around RI down into that framework. Our statement of responsible investment principles, the only thing I'll flag here for you is it's like a lot of other RI policies, except that we have a focus on labor rights, the basic right to organize collectively and bargain collectively. The role of public services is another area where we focus on. So we're very concerned about sustainability of services. We're concerned about privatization leading to the hollowing out of the capacity of the state. These are things that, even leaving aside my personal views or our personal views about these matters, from an investment perspective, privatization that undermines public support or that leads to controversy or leads to mismanagement can really be an investment risk as well. So it's one of the reasons why we focus on it. And it's part of a growing trend to develop the RI policy. So we have our own, it's on our website, you can check it out. It's a very important piece for the board as well. They're very interested in responsible investment. In terms of performance metrics and benchmarks, so if we're not chasing returns that are just slightly better than our peers, or, people will often, you may have heard them in the past say, well, the Toronto Stock Exchange lost 10% last year, but we only lost 8%. Isn't that great? We outperformed the stock market. Well, that's great if you could eat a minus 8% return, but you can't. So we're moving away from trying to beat stock market benchmarks, and we're trying to set up new benchmarks. We actually have set up benchmarks that are directly tied to the sustainability of our plan. And it's the role of the board to monitor those metrics, to make sure that our performance is in line with what we promised, and to hold us to account if we do not meet that mark. So at OPIE Trust and in a lot of funds are moving towards different kinds of benchmarks. Our benchmarks are based on, are we keeping the plan 100% funded or more over a 5-year period? Are we getting the same, a better return at a lower risk than our reference portfolio? So if our reference portfolio that the board set is 75% stocks, 25% bonds, are we getting a better return than that is expected to produce at a lower risk? That's a key metric. That's risk efficiency. And finally, surplus preservation. This is where you get to the, if we had a massive 2001 or 2008 adjustment, how would we perform relative to the reference portfolio? Are we really, so that's two notions of risk. There's risk as you go along in any investments, like I talked about before, risk return, and then there's risk to your funded status, your ability to recover if you're a mature pension plan. That's what surplus preservation really looks at. Can we survive another downturn? And are we doing a better job of survivability than we could get just by a more simple investment strategy?
Some plans, in part of their planning for what they're trying to fund, it's not just the 100%, but they also put in a contingency fund. So just in case the market goes up or down, they can absorb the shock. And I think that's something, when we're talking about surplus preservation, it's not assuming we're going to pay every money back to a whole bunch of people. It's to keep the plan sustainable and working.
Absolutely. Yeah, absolutely. That's a good point. So the board takes these metrics and approves a risk appetite statement that says, look, this is what we need to do. This is the kind of risk that we're willing to take on, and this is how we're going to measure it. And that is how they hold us to account for our performance at the end of the year. And if we do this the right way, we will have moved away from our asset management organization mentality towards our pension management mentality. So addressing funding risk, risk allocation. We're driven by the liabilities represented by our pension promise. We're dynamic. We can adjust to changing environments quickly. We're looking at the short term, the medium term, and the long term at the same time. We're flexible. We're working together across asset classes. And where appropriate, we are using internal resources rather than paying extra for them by going outside. If we do all those things the right way, we will truly be a pension management organization. That is the path we're on. It's a path many pension plans are on. And that is where I will end my presentation. Happy to take any questions at the end of this presentation. And now I'd like to pass it over to Liz.
So thank you, Jordan. It's Diana here. I'd like to introduce our second presenter, who is Liz Thompson, and she currently is a labor relations consultant at the Health Sciences Association of Alberta. In addition to her responsibilities within that leadership role, she provides advice and guidance to staff and members, including disability insurance, workers' compensation, health benefits, and pension benefits. So she also serves as the board of directors with the Alberta Workers' Health Centre, and serves on the board of directors with the Grant MacEwan University Disability Advisory Committee. So I'm going to turn it over to Liz, and she's going to focus on what the role of trustees are and what you need to do as a trustee or someone assisting in investing. And I leave it to Liz.
Okay, thanks, Diana. So I'm going to talk about some of the duties and the roles of a trustee. And one of the roles and the duties that a trustee has is the fiduciary duty. And a fiduciary is someone who is responsible for looking after the interest of someone else. And that someone else are the plan members and the beneficiaries. So as a trustee, you have an obligation and a duty to take reasonable steps and proper care when investing the trust assets of other people. So in conjunction with that, trustees must also act very prudently in their selection of the investments, keeping in mind the terms of the trust and the interests of the beneficiaries. So when investing in the trust property, a trustee must exercise the care, the skill, the diligence, and the judgment that a prudent investor would exercise when making investments. And trustees also, they can delegate investment decisions and seek specialized advice. So because your job as a trustee is to set policy, you're entitled and expected to delegate. So, but keeping this in mind, however, that you're still responsible to a certain degree, even though you delegate. So the initial decision to delegate must be in accordance with the prudent investor standard and include prudence in selecting, instructing, and monitoring their agent. Trustees have to keep the portfolio reasonably balanced, as Jordan had mentioned previously. So when you look at the portfolio as a trustee to get the right balance with diversification in mind, you would consider some of the following. The general economic conditions. In today's environment, we're looking at lower growth and the possible impact of inflation or deflation. Currently, we're looking at lower inflation, the expected tax consequences of investment decisions or strategies, the role that each investment or course of action plays within the overall portfolio, and the expected total return from income and the appreciation of that capital. And lately, we have been seeing lower interest rates, and also the needs for liquidity, regularity of income. We always have to look at that balance, and the preservation or the appreciation of the capital. So all of this has to be kept in mind, like Jordan had mentioned previously about the balance and the scale. So investment powers must be exercised so as to yield the best return for the beneficiaries. This means that trustees are under a duty to determine the extent of their powers of investment and diversity. And because contributions form only a small percentage of the plan's total assets, the increased contributions will only eliminate a funding shortfall over a long period of time. So as the plan matures, increasing contribution rates will be even less effective in addressing any funding deficiency. So consequently, investment earnings will be the primary means of funding the plan in the future and a source of funding volatility. So a board needs to establish a good funding strategy in terms of managing the funding volatility, and under certain circumstances may also consider the reducing of risk. And as a board, we also have a statement of investment beliefs. So this statement, it sets out the investment beliefs of a board of trustees. It's the foundation of the investment policies that govern the management of the trust funds. And it also serves as a guide to the board to consider and in consideration of investment issues that may arise in the future. This is a living document as a board of trustees that we live by and we follow. And some of the factors to consider when conducting this review are the investment objectives. The investment objectives of the plan is to fund the plan's liability on an ongoing concern basis. The risk and the risk management. Key funding risk factors include interest rates, inflation, mortality, plan maturity, and asset returns. So the asset returns need to be considered on a risk-adjusted basis. We also look at the asset mix. It's a tool for trustees to achieve its investment objectives. Diversification. Diversification to some degree can mitigate risk. And the investment horizon, the long-term nature of the plan's liability over the long term must be considered. Active management is another part we look at. Some markets are more efficient than others. That's why we need to have active management. That's why diversification is so important. And responsible investing. A board of trustees believes that companies that adopt good governance and responsible practices can be expected to enhance shareholder value, which is consistent with investment goals. So to do the assessment, the assessed liability study, some of the things that we do when we are looking at the study is to assess the sustainability of the plan. We look at the actuarial assumptions, which help set the discount rate. We review assets, liabilities of the plan for financial sustainability. And we look at the financial status, the plan's long-term obligations, and the assets needed to meet those obligations. So all of the above should be considered to ensure the long-term financial sustainability of the plan. And when we do this as a board of trustees, we consult with our actuary, our investment manager, our legal, our investment consultants. We need to speak with the specialized people and get specialized advice from the experts in order to make the sound, informed decisions as a board. In the assessment liability study, we look at the assets, what we own, our investments, our interest returns, our contributions, and we also look at our liabilities, what we owe, which are the benefit payments, our expenses. We look at the economics, the discount rate, salary growth. As we know currently, there's lower salary increases. We look at the number of young people joining the plan. Another thing we look at with salary growth is, are the employers replacing when people are laid off or when people leave the employer? Are they replacing these people or not hiring the people back into those positions? So that all will affect the salary growth when we looked at this in a pension plan. Inflation. Inflation is a factor in determining expected return. Life expectancy under the demographics. Life expectancy is there's increasing longevity. So how does that affect our plan? We look at that. Retirees are living longer and therefore drawing money from the plan for a longer period. We look at the retirement ages, the withdrawals from the plan, the different patterns and trends, also the age differences between spouses. So how does this affect our assumptions? That's what we ask ourselves as a board of trustees. The discount rate is the most important assumption. And how does all of this affect our expected returns? And that's why diversification of investment is very important. When we look at targeted investment provisions, the Board of Trustees will follow plan policies and procedures to ensure that the investments that are made in the best interest of our plan members. Trustees should consult with the appropriate investment professionals in the selection of investments to ensure that acceptable levels of diversification, returns, and risks are maintained, and that the screening criteria do not negatively impact the rate of return. And trustees they also have a responsibility in the selection and review of the investment managers. Trustees' involvement in the selection of the investment managers is essential and should be articulated in the SIP. The SIP is the Statement of Investment Policies. In the context of jointly trusted pension plans, if responsibility for selecting and evaluating managers is left to an investment committee, the committee should have representation of both the union and the management appointed trustees. And in all cases, the SIP should require that the Board of Trustees as a whole have the final say on the selection and review of the investment managers. We also have a conflict of interest. Care and standard. We have to follow a policy for conflict of interest. If there's a conflict, we as a Board of Trustees, we need to disclose before we even just start to discuss any matter that there is a conflict or there could be a potential conflict. So it can be addressed to see if we need to proceed. But also pension trustees have a fiduciary duty to treat all plan beneficiaries, present and future, with an even hand. So accordingly, people entrusted with managing assets on behalf of others must also be aware of the potential conflicts of interest. So pension trustees have a fiduciary duty to set aside their personal interests and act in the interest of the plan beneficiaries. Similarly, the investment managers and other professionals retained by a pension plan must execute their responsibilities in a manner that is consistent with the best interests of their clients. There is also trustee education and training. All trustees require current and comprehensive knowledge about investment principles and plan governance in order to make the prudent investment decisions. Trustees have the right and responsibility to obtain the education they need at the plan's expense in order to engage in a meaningful way with other trustees and the investment professionals about matters pertaining to the plan's investment policy. So when we do this, boards, when trustees start on a board, there's usually ongoing training during the first year. They have training when they first come on to a board. They usually are assigned a mentor. And then there's a list of courses that you can take to get certification. There are conferences you can take. So there's education that is going on right from the very beginning when a trustee starts on the board. And there is a need to always have ongoing learning so that you keep up on things so you make the best decisions. And a trustee has a duty to question everything. Trustees may seek advice from professional investment advisors, including actuaries, consultants, lawyers, as well as other unions, other pension-related organizations, to assist in setting responsible investment policies. So in doing so, it's the responsibility of a pension trustee to actively engage their advisors in the development, implementation, and review of investment policies by asking questions about the things they do not understand. Sometimes trustees feel intimidated. They presume that they should know the answer even though they're not sure. Well, that's why we have professional advisors, and that's why the board retains professional advisors to serve the needs of the trustees. So when there's confusion or uncertainties, trustees have a duty to ask questions and should not feel shy or intimidated when doing this. Trustees should also be aware of any potential conflicts of interest on the part of those providing responses to the questions. So I would say as a trustee, you need to be prepared and be a positive ambassador. So in summary, the Board of Trustees has a responsibility to establish and maintain policies and objectives to ensure the pension promise is met. The investment policy is the initial step in a long journey towards successful investment. To keep that pension promise and to meet the plan's obligations, assets must grow at least in tandem with the liabilities, the accrued pension benefits, over the long term. So the investment policy is the foundation from which the internal control, sorry, can be built. And the financial and the non-financial criteria that may affect financial performance, that must be considered. Both must be taken into account in making investment decisions. Pension funds trustees' fiduciary duty in investing pension funds is, as far as possible, to try to ensure that there are funds with which to pay pension benefits owing to the members, both at present and into the future. There's a duty of loyalty on pension trustees. Members have made contributions to support their own retirement to the pension trust. The obligation to deliver that pension promise, the promised pension benefit, that's what a trustee must ensure. The investment policy is to meet this obligation. So factors that are relevant to investment decision making is evolving, and you must consider a large range of factors. Thank you.
So thank you very much, Liz and Jordan, for very substantive presentations. I'm going to take some questions from our attendees, but once again, I'd like to remind you to submit a question that you can type into the question box in your GoToWebinar control panel if you wish to. And I'd like to start with Jordan. Given the fact that you're the person that deals with the trustees, what do you expect to hear from trustees? What should they be asking you as a trustee if they really want to be doing their job well in the investment side?
Okay, I don't actually work with the trustees directly anymore, but I used to be a trustee. Right. So from that perspective, about our investment strategy, I would expect them in our results, they would often ask, are we fully funded? Can we meet the pension promise? It's like a basic, are we on track? How much risk did we take to get to where we are? And do you have any concerns from a reputational perspective or a responsible investment perspective? They'll want some feedback from us on how we see economic conditions, how that affects us from a RI perspective, and how it affects our ability to meet the pension promise. So we'll want a bit of an environmental review as well.
Okay. Liz, I'd like to ask, what are 3 challenges that you see from a trustee's perspective when it comes to investment management? It's the 3 biggest challenges, I'd suggest.
Well, I mean, especially now, we're facing a few challenges the way things are. But like one of the big challenges right now that pension plans face are how to ensure the funding of the plan during these economic downturns that we're having. So currently we're seeing a decline in investments because of lower oil prices. The Canadian equity market, it's been a roller coaster ride, I would say, in the past year. So, we look at this as how do we handle all of this? Well, one of the things we say is, and we as a board of trustees, is don't be pressured to respond to short-term market fluctuations. So don't react too quickly. You have to be very careful. You have an investment policy there that maintains the long-term focus that serves, a number of important functions. So I would say you need to work with your actuary to know what the health of the plan is. Work with your investment managers to understand where the investments stand, the investments of your plan, and the outlook for going forward. And to ensure that you look at, review your risk tolerance, you need to evaluate the plan and look at it to measure and to mitigate those risks. So look at that risk appetite again. But make sure that you're satisfied with the investment management approach and the performance and the action that's being taken. And if you're not happy with it, then you need to have that discussion with your actuary, with your investment manager, with your investment consultant, to ensure that you take action in a timely manner when you're not satisfied. So again, going back, I would say biggest challenges are now with the economic downturn, the lower oil prices, the markets the way they've been, you know, up and down, and to ensure that you maintain that conversation with your investment manager to discuss how things are going and if you need to adjust how things are divided in your plan.
Okay, thank you. So once again, I'd like to thank our presenters, Jordan and Liz, and all of the participants for being here today. If you have any questions or comments about today's webinar, please email info@share.ca. The next webinar in this series focuses on pension law and will introduce participants to pension benefits and tax laws that shape pension plans in Canada, and as well highlight the role of the trustees fiduciary. If you want to attend or find out more information, please visit www.share.ca/NUPGE-webinars to register. And thank you again for joining us.